Mr. Charles Dow and Dow Theory. And we're going to be actually talking about how a man can be so smart, but not see what's clear in front of his eyes. Can't put the whole picture together. Now, Charles Dow, we all know, or we don't know Charles Dow, we all know the name Dow. We know it from the Dow Jones Industrials, the DJI. We know it from everything we read about the Dow. Nowadays, every trader's heard of the DJIA. It stands for Dow Jones Industrial Average. What many of us don't know that the same name comes from its founders, Charles Dow. He was a brilliant thinker. Dow was fascinated with how the markets move. Relentlessly, he tried to find logic to it. Now, I'm a firm believer, personally, that the markets are entirely random because they're made up of millions of people around the world making millions of independent decisions. But there are certain times that the markets exhibit non-random behavior. And this is what Charles Dow tried to observe. So we all know that the market swings result from supply and demand imbalances. More buyers, the market rises; more sellers, the market falls. Okay, but how do we generate more buyers or more sellers? Now, of course, volume matters too. And that's an important thing to keep in mind. Volume, and we're not talking about just trading volume at the moment. We have things like seasonality. Over the summer, typically, let's forget now with Corona, but typically August is the slowest, most inactive month of the year because most of the world's on vacation. So volumes are down. When volumes are down, it's easier to interest or find more buyers or more sellers. News has a bigger result. Press releases have a bigger result because there's less people involved in the market. So the markets are more, not positively responsive, but more reactive. Then we always have Christmas week, New Year's week. So many people are on holiday. Markets are dead quiet. Then you have the times when the US markets are closed on holiday or Chinese markets. It always affects the volume of what's going on. Now, the idea that the market moves in waves and such imbalances created by them. Okay. Now, wave theory is kind of complicated. But Dow theory was based on this principle, and like Elliott, who came up with Elliott waves, Dow tried to figure out human nature's influence on market behavior. Now, let's think about waves. If you were to throw a little pebble into a pond of water, you'd get a ripple effect and a little bit of waves. But if when those waves were emanating out, you threw another stone a little bit farther out that would react with those little ripples, we'd actually see waves. You threw a third stone a little farther out, you'd see more waves, and they would get bigger and bigger until they would ease down and ease out, and then another stone in. Well, waves have principles, and Dow tried to explain these. After all, a combination of swings creates a trend, and that's what happens when we get these swings, these ripples in the market, but they get larger and larger and larger going in one direction. What do they create? A trend. What if one can put an order in the market swings? Dow theory is not the only approach Dow had to understanding markets. He wrote many reports that served as a barometer of general business activity, but he never put his ideas together. And this is what's the amazing part. Dow, who spent his entire adult life studying the markets and came up with lots of theories, but each theory was independent of the other, and he never saw the big picture of how I'd put them. He never sat back and said, wow, I've got this theory, I've got that theory, I've got this idea, I've got that idea. How do we put it together in one big picture to explain the markets? Never did. In fact, it was Sam Nelson, somebody most of us have never heard about. I never heard about it until I started studying Dow. He was a market technician of the time. Remember, this is in the early 1900s. There was not many market technicians. There was not much of a market. And he's the one who actually coined the phrase Dow Theory, because he put everything Dow had put together, all of his principles, and made sense out of them. And he was the one who actually put it together and built the main pillar of technical analysis. Now, he didn't come up with any principles. And he never tried to claim he did anything else. He put together all of Dow's thoughts. Today, the Dow Theory principles shape the way traders look at trends. Moreover, Dow Theory technical analysis concepts have a great forecasting power. Later, William Hamilton redefined the theory into what it is today. And in 1932, Robert Rea went even further. He put together Dow's, Nelson's, and Hamilton's finding. As such, the Dow theory of technical analysis concepts was born. Now, up until Dow, again, remember, there was a small market, but everything moved on fundamentals. It moved on hearsay. It moved on news. It moved on whatever data, not trading data, but whatever market data. Yeah. And remember, there weren't that many stocks. There weren't that many commodities. But nobody looked at price charts. Nobody analyzed price movement. If you heard that there was a problem in Florida with the orange juice, the price of oranges, the orange juice price went up. But nobody looked at a chart and said, oh, look at that. I can see this trend rising and it should hit this point. No. So keep in mind that the original Dow Theory technical analysis principles were modified in time. The following are the most important considerations. And these are also the same pillars of all technical analysis. The market discounts all news. A powerful statement, especially for the Forex market today. Now, it's very hard to say the market discounts all news. But if you were to say build a black box system or have a robotic trading system, it would all be on mathematical equations taking into account indicators, oscillators, volume, price movements and everything. It couldn't analyze the headline news of the paper. But the minute the headlines came out, the markets reacted, it could take into account those reactions. But today in the Forex market, it is very difficult to be strictly a technical analyst trader. We can't ignore news and economic events because it may not affect the price, or it might have been already factored into the price. Say, for instance, we're expecting the jobs report, the big US jobs report comes out the first Friday of every month. Now, the markets have already factored in that they think it's going to be a very good report, which should see that you should have seen a small increase in the dollar, a drop in gold. And we saw on the charts overnight, an hour or two before the results were due out, we saw gold dropping, we saw the dollar going up. Markets were already factoring in everything, so they didn't need the news. But the fact is, the report came out pretty much where it was expected. Okay. So we shouldn't have had any reaction. But the fact is, as it's coming out, traders are acting and reacting. A half hour later, it might be exactly where it's supposed to be, but it can cause volatility. And that volatility, especially in the Forex market, and especially with CFD trading and leveraged products, can cause you to get stopped out. And you end up on the bad side of what should have been a good trade. So today we can't ignore the fundamentals and just take into account the technicals. Now, with trading algorithms interpreting news and snippets, discounting the news gets difficult. Yet a market move based on human interaction and human program robots. As such, the market in the end will discount all news. The market moves in cycles, either bullish or bearish. Dow identifies 3 cycles: the main movement, the medium swing, and the short swing. At least those were the original names. Time distorted the notion, but the idea remained. To this day, Dow Theory has 3 market movements going on simultaneous, and that's important. And remember, volume confirms trends. That's tricky in the Forex market because in the Forex market, we can't actually see volume. There is no exchange calculating volume. So when you look at a chart and you click on the volume indicator or or just volume, it's only showing the volume that goes through, in most cases, that liquidity provider. Now, he could be a big liquidity provider, but he's not a global liquidity provider. So the volume shows only the broker's transactions or the liquidity or the market maker's transactions. However, it offers a good educated guess because this liquidity provider or this market maker, he's not going to be getting more trades than the other guy in this direction or that direction because they don't take them in that, that way. So it does give us an educated guess of what volume could be. Now, trends exist until they end. And trends have pullbacks, and Dow tried to spot true reversals from fake ones. And what do we call them today? We call them retracements and reversals. With these basic points in mind, let's try to see what makes Dow Theory fascinating. So the basic tenets of Dow Theory, the 3 stages of Dow Theory technical analysis are: the Dow Theory considers the market makes 3 price movements: the primary movement or the primary trend. This is where Dow Theory Forex traders focus. It can last from a few months to a few years. So remember, what we look at is long-term, medium-term, and intermediate, long-term, medium-term, and short-term trends. Okay, he called them primary movements then. The secondary movement, this is the reactionary movement. It goes against the main trend or the primary one that goes on for weeks or for months. Now, remember, when Dow was around, we didn't have online trading. We didn't have the Forex market, and we didn't have all of this immediate, we didn't even have, advanced charting. We didn't have we didn't have the internet, and we didn't have computerized charting. But what he was saying is, first primary move is this way. Then you get a move that way, and then you get a third. And he was actually able to give you a value to this movement. But this is the primary, this is the reactionary, and then they go with or against the main trend. It can take from hours to days. So what did Dow give us? He gave us the movement of trends and also the movement of waves or cycles. In today's online trading, there's a trading style for each movement. Traders involved in the biggest cycle, the primary movement, are long-term traders. The next cycle belongs to swing traders. And then finally, intraday traders deal with day-to-day movement or daily fluctuations. You probably noticed that Dow Theory addresses the market cycles, but in today's technical analysis, the 3 movements represent a bullish or a bearish trend. So how do we define a trend? With price making a higher high and then a higher low, and a higher high and a higher low, a higher high and a higher low. And when the market eases back down and makes a lower low, that trend is ended. And this is the standard definition that we use today of a trend. But Dow explained it as his theory before we had trends. So a series of higher highs and higher lows in a bullish trend. On the other hand, a bearish trend is a series of lower lows and lower highs. A closer look at the image shows what Forex traders know as a trend's definition. After all, what is Dow Theory if not the concept to ride the trends? But as always, there's a catch. The Dow Theory technical analysis deals with bigger trends because in the 1900s, we only had basically investing and long-term trading. A trade could take a day to 2 days just to even be handled, processed. In today's Forex market, it starts from the bigger time frames and moves to the smaller ones. So Dow's primary trend was what we call the accumulation stage. So the 3 stages of any Dow Theory analysis consider market psychology. They prefer in a bull market or bear market. Before a bull market trend starts, the market accumulates. if you want, it builds the energy to break higher. So in most cases, we have sideways movement, congestion. We'll start moving up, and then we'll start moving into an uptrend or the other way into a downtrend. But at some point, it starts building momentum because you have to start building that momentum. But once the market has built that momentum, that trend will most likely continue on. And it builds energy to break higher. Excessive pessimism at the end of the previous bearish trend ends. Only the brave ones buy here. In today's Forex market, triangles show accumulation. So what we have in a triangle pattern is we have here, and we have price moving in to the apex of the triangle to break out. And it can break down or break up. But the market's contracting and then pushes out. Now, let's take, for example, the Euro monthly chart shows a triangle, not any kind, but we'll go over and look at it in a second right here. Shows a triangle. That's the accumulation phase. And then we get the breakout phase, and we start moving into an uptrend. So Dow Theory technical analysis principle called this the accumulation stage, or the first stage in a new bullish trend. Accumulation phase, first stage of the trend. And then price starts making higher highs and higher lows and starts moving into a beautifully well-deformed uptrend. Push, ease, push, ease, push, ease. Always making higher highs and higher lows. It isn't until this point that we actually broke the lower low, and that tells us at this point that trend is over. When we weren't able to make a higher high, that was the first warning that things were in trouble. And then when we couldn't, we made the lower low, that trend had, it was over. Sorry, just let me erase these. Traders wonder, what is Dow Theory used for? Well, here's the answer. It tells you with great accuracy conditions for market turns. And it does this way ahead of time. Traders only need to pay attention to the details. So we went into the accumulation stage. And then when we started getting that breakout, this is what stage 2. And this is the big move. Once price accumulates and builds that tension in there and breaks out, okay, we should see a big move. This is stage 2. We should see this confirmed by volume. This is the longest stage of the primary trend or the primary bull market. Typically, fundamentals come to help. Interest rates rise because of improving economies or similar. So here's now the primary trend. Bears are crushed, bulls are thrilled. And then the bulls get a reality check. Secondary pullbacks become more powerful. What ends up happening is price pushes up, makes a higher high, makes a lower low. But then we start to see that the bulls aren't losing interest and the trend hasn't ended, but most of them are already in the market. And they're saying the price is too high to re-enter the market. They're letting their trades run, but we don't have that buying power to keep pushing it. And at some point, it starts to peter out because the traders that were in the market say, okay, I'm taking my profit. So we have these secondary moves within this primary trend. Moreover, excessive speculation is visible. However, confidence is still high. Any meaningful pullback sees buyers stepping in, yet smart money sense something is wrong. Sellers appear, and in the end, the trend turns. And then we go into stage 3, the excess. In a bearish trend, the first stage is identical to the third one of a bullish trend, only that its name is different, and Dow Theory calls it distribution. As such, the third stage in a bull market is the first one of a bear market. What next? Again, the series of higher lows must be broken. So this is what we call the distribution. This is equal or the opposite of the accumulation, because we can't say in this we've moved to a downtrend. What we know is the uptrend is over and the traders are accumulating, or at this point distributing their wealth and their profits as the markets start to gather into a trend in the opposite way. There's no rule that we can't then break into a new uptrend, but we will most likely break into a downtrend. Now, all this was observed by a guy in the 1900s with no computers, no data, by sitting there just watching prices. And he was only getting prices probably every couple hours and very slow markets. He didn't have this huge amount of data flying in and out through computerized charts to make his observations. So these observations were quite unique and quite intelligent, quite forward thinking. So as such, the three stages in a bearish trend are the exact opposite of a bullish trend, but we go to distribution, the big move, and then despair. But that is not all. As Dow Theory introduced theoretical concepts too, one that forever changed the way traders look at charts. And the averages discount everything is what is Dow Theory. One of the biggest beliefs is Dow had been that everything is priced into the markets, that all known information is already in a market move. After all, this is the very core belief of technical analysis. Technicians have a very analytical mind. No matter what the fundamentals say, a technical concept remains a technical concept. The market already discounts the news. And like I said, the markets, like I gave you the example of the jobs report, already had discounted the news, except in our type of fast online trading, we have the volatility. See, back in the old stock days and things were trading slow, that volatility never got accounted in the price, because that half hour or hour of volatility didn't occur. It occurred maybe on the floor, but not in the chart when you saw the prices, because we weren't charting in 5-minute, 15-minute, we weren't getting the data. Now, Dow theory and the concept of confirmation. It's another principle from Dow. But perhaps the most powerful concept is confirmation. Dow theory technical analysis called for trend reversals to be confirmed. In today's technical analysis, this concept is widely used. Think of it a bit. When we see a market that we think is reversing, an indicator is telling you that the trend is over, we want to confirm it. We'll either confirm it with volume, with another indicator, with a price pattern, with a candlestick pattern. So what do Forex traders use to spot reversals? Oscillators, RSI, stochastics. More exactly, divergences with an oscillator. The original Dow theory stated that a change in the primary trend must be confirmed by other indices. In today's technical analysis, a change in the primary trend must be confirmed by divergence. As such, today's Dow theory technical analysis is incomplete without divergence. Traders use either RSI, relative strength index, or other famous oscillators. The idea is to stick with the oscillator and not with the price. Because the oscillator considers more candles, chances are the price makes a fake move. That's the confirmation that Dow theory looked for. And what is Dow theory? It's volume confirmation. Rhea and Hamilton, remember the two people we talked in the beginning that were two of the people who put together all of Dow's principles. So Rhea and Hamilton expanded Dow's idea about confirmation. Volume came into the discussion. The idea is the following. In a primary trend, the volume should increase. However, not in any direction, but in the direction of the trend. So imagine we're in Chicago, where they bring in all the cattle to be sold at auction. And we're talking about pre-commodities agricultural exchanges. Okay, so they brought on all the cattle, and its prices going up. and moving up faster, more and more buyers are jumping in the market because they need to buy their cattle before the price gets too high. What would you see? You'd see the volume going up, because if they're in the morning start trading at 59 cents a pound of beef, okay, and buyer said my range that I can buy of the 59 to 61, he thought price might ease down a little bit, but then he saw it going up to 62. He said, well, I better buy now because I need to take my cows home to, and I'm leaving on the train this afternoon. Okay. So we would see the volume increasing in the direction of the movement. So let's consider a bullish trend. The volume should be bigger when the market advances than during corrections. The chart shows volume of the euro US dollar earlier now. So we notice an increase in volume after the biggest secondary move. See right here, we moved into the secondary move. We had accumulation, then the secondary, and look at that increase in volume, because that's when the price of the cows went 59.61 up to 62, and the buyers are buying fast because they don't want it. They need to get the best price possible, and they don't think it's going to go back down. That's a confirmation of the bullish trend. Yet another one set by Dow. Dow Theory is the first one to treat market psychology. A closer concept of Dow Theory analysis is the Elliott wave theory. Elliott went into more detail. He took the main trend and found a 5-wave structure unfolds of a lower degree, or waves within waves. What I told you about the pebble being thrown into the pond and the ripples and another one, ripples, and that's what these are. These are the ripples within the bigger ripples. Then the secondary movement of the reaction, he called them corrections or corrective waves. This is the Elliott wave theory, a 5-wave structure corrected with a 3-wave one. To sum it up, the Dow theory calls for a primary trend, one that forms on bigger time frames. It keeps building higher and higher, higher highs and higher lows, or lower lows and lower highs. The trend goes until the series breaks. The 3 stages make a trend, and confirmation is needed when the trend breaks. Confirmation comes from divergence, or from a correlating market that doesn't confirm the move. In Forex trading, it comes from a similar currency pair. For example, if the pound US dollar and other dollar pairs didn't confirm the US dollar move, the markets diverge. So in other words, all the other crosses were not going the same way as the euro US dollar. That tells us most likely that the euro is gathering momentum and the US dollar is either easing or not, and it confirms the movement of the euro US dollar, or there's no confirmation. Other traders use volume. This works extremely well in the stock market. To some extent, it works in the Forex market too. Now, if you think, all of these sound relatively easy, and all of you as traders are told these every day in our Forex trading, our CFD trading, but nobody had any idea really where it came from and how amazing Dow was able to envision all of this with the limited data and the limited markets he had. And the fact is that it still holds true today. Today, the Dow Jones theory and technical analysis is widely used in Forex trading. Like it or not, know it or not. Are you an Elliott wave trader? I'm not. I've had to explain, I've even taught classes in it. I just don't, I cannot see the waves within the waves. Because I don't know, I can't, they confuse me. But I firmly believe in it. If yes, then you use basic Dow concepts. Are you a technical trader that uses divergence? Yet another Dow concept. All in all, Forex traders have an edge when using Dow theory principles. They understand what drives the markets. So I hope you learned a little bit about Dow and where all the background of all this theory comes from. So when you're trading, you understand how and why you're making the decisions and not just blindly trading. And you can then take this and put it into your understanding of the markets. So thank you very much. Thank you for supporting Invest Markets, and we'll talk to you again real soon. Bye now.